Hey there, I am John Stevenson. Welcome to the Guarantee Retirement Guy Show. Let's talk about why wealthy retirees are moving away from the traditional portfolio status. All right, so if you are thinking about different allocations for your portfolio and you're wondering if you want all of it in the market or if you want all of it in the mutual fund, in mutual fund allocation, the strategy that your advisor is trying to tell you to put it into, and he's saying, hey, you're going to get all this growth, you're going to get all this income, and you have this floor of where it can't go past certain losses, right? Like maybe your losses will be, stopped at 15%. Okay, that's where they'll limit your losses. So if your account value goes, if the market goes down below 15%, at least you're not going to lose more than 15%. Of course, when the market goes up, though, if it has a really, really big year, you get 30%, you might get 20%, right? There's always a cost to that protection. But unfortunately, with a lot of these, people are like, well, and I have a lot of wealthy retirees that reach out and they're like, I do not want this money exposed to risk. That is probably one of the biggest reasons that a lot of wealthy clients of mine, they're using annuity contracts. So I sell annuities and I help people with guaranteed income streams, and I show everything that's available. I don't show you one or two products that pay me the most. I show you everything, because a lot of times the products that pay you the most don't pay me the most. But that's what they're for. They're for your portfolio, and they're for giving you the most return on your hard-earned money. And so that's what I focus on. So if you want to look at my calculators, go to johnstevenson.com. Look at the income rider calculator if you want the highest income, but there's also other annuity options on there as well. So it just ties into the carriers, and then you can do your own research. And if you feel comfortable, you can reach out to me. And of course, I can help you if you'd like to purchase one. So, but let's talk about, and I want to share my screen. Let's talk about the numbers that you can get from a decent size annuity contract. Because if you're looking to maybe allocate some of that money, maybe you're thinking, well, I've got a stock bond portfolio, but I just want to keep everything in stocks, but I don't really necessarily want it in my bond portfolio because I'm worried about interest rate risk and what that can do to the value of my bonds. And so I'm not sure if I really want that in there as well. Because a lot of times, at least what we've seen in the past, usually we're hoping if stocks go up, bonds will go down and vice versa, right? Or if we're having a bad year for stocks, our bonds are going up and we're doing all right. But that hasn't always been the case. And so that is a real risk. And especially if you got a portfolio that's $5 to $10 million, that can be a real problem. And of course, your advisor doesn't want you to move your money into annuities because they want to make sure they make the fees on the total assets managed. But you got to do what's best for you. And so a lot of times what people are doing, they reach out to me and they got $5 million in assets and they're like, we want to take $2 million of it and we want to put it into this annuity contract. And that will serve as our bond allocation. We don't want to have it in bonds. We don't want to have it in CDs. And so we want this bond allocation. So a lot of times what they'll do is they'll either stick it in a MYGA, which is just a fixed annuity that pays you a fixed rate of growth that's higher than a CD. And so they'll do that and they'll park their funds there. And that's a good place for parking it. But if they're looking for income, then a lot of times what they'll do is instead of doing a MYGA, they'll throw it into an income rider that pays them a lot of lifetime income, which is the whole reason why they have this portfolio in the first place, is to have income, right? Is to have a nice retirement. And so let's look at that. So I'm gonna share my screen here, and this is a couple who is married in Oregon, and they are 60 years old. They're taking joint income, but they're going to wait 5 years. So they know they're going to retire in 5 years, and they want to start taking income from this portion of their portfolio. But instead of having it exposed to any risk in their current portfolio, they chose to take $1.5 million. So they got $4.5 million. They want to take $1.5 million. They're taking 30% out, and they're going to put it into an annuity. Okay. And it's not only an annuity, it's an annuity for guaranteed lifetime income. Okay. So based off of that, if we scroll down and we look at all the options, these are all the options. These are annual numbers. Okay. Then you'll notice that Nationwide happens to be the top one. And this is for joint. Now, if it's a single person, it's going to be more because now the insurance company is only on the hook for one life. And you can see the income is like $166,000 a year. So, but let's go back to joint because, if we're looking for just highest income and we want to make sure that our spouse does not run out, then this is the best option because, and again, this is an income product. I can show you the MYGA right after this, but if you're looking for an income product with that portion of your portfolio, then this is a reason why a lot of wealthy people are doing this because they want income for them and their spouses. And it allows them mentally and emotionally to leave their other money in the market and grow it. I mean, you got a $4.5 million portfolio, you take 1.5 and put it into this, you're getting income. Maybe your Social Security is, makes up the difference and brings it up to $200,000 a year. That's pretty good. You're getting decent income from that. And you only use 30% of your portfolio. The other 3 million, if you leave it in the S&P 500, at least history tells us that that'll probably double in 7 years. That's pretty good. Now you're back up to 6 million, but you still got a pension. A lot of my wealthy retirees are doing just that. They're taking a portion and they're putting it into an annuity. They're getting their base covered. They're giving their guaranteed income covered so that they can continue to invest the way they want to and not be in a 60-40 split, but maybe they want to be in a full 100% stock. They want as much growth as possible, and they're okay with the risk because they know they don't have to live off this account anymore for income. And that's why it works so well. And that's what the wealthy are doing. They're getting richer that way because they're not using their whole account for income. They're using a portion of it for income, and they'll set that aside. They're not worried about the account balance. They're not worried about that. They literally will spend that portion of their portfolio and spend it wisely on a contract. So for instance, this one, if you look at Nationwide, they spent $1.5 million. They left $3 million in there to grow, and in 7 years, they're anticipating that to double to $6 million. Pretty darn good. Another 7 years, that's going to be $12 million. Were they really hurt? No. They were allowed to be more aggressive, be more risky, and earn the wealth that they wanted to earn, right? And an annuity contract allowed them to do it. It allowed them to get wealthier. Okay, a lot of people look at annuities and are like, oh, annuities are terrible. Annuities are terrible. Yeah, annuities don't make money. They're not for that. They're for income. Buy it for income. That's it. Okay, and then invest the rest of your money and build a lot more wealth. And it allows you mentally, emotionally, financially to be able to do it. So Nationwide Peak. So this is the top one that we're looking at. Worst case scenario, if there's no index growth, then the account balance will be gone by the time you're 73. Who cares? Okay. But at that age, your account balance has already like doubled twice. It's already at 12 million, your other account. Who cares? Okay. You're getting this for $156,000. That's what you bought. Now, if it does have some growth, which it will, then it's going to last a little bit longer. And see that's your death benefit. So if you die before using it all, your money's not wasted. It's just being leveraged for a pension. Now that money will go to your beneficiaries. You look over here to the right, here's the death benefit. So whatever the account balance is not used up goes to your beneficiaries. It's pretty simple. So you're taking $1.5 million, you're buying a $4.6 million pension. You're spending part of your retirement the right way. Instead of taking $5 million or 4.5 or whatever it is and saying, I want to generate income and I want to get growth from this and do it all together and my advisor is going to take care of me. Make it really simple. They're taking 30%. I mean, you could take more than that. Take 2 million. There's nothing wrong with having more income. You saved it up for that. Otherwise, if you don't spend all your money and you leave $5 million behind, then that might equal the 10 years of your working life that you didn't have to work, right? What are you willing to give up? You want to spend it? You want to use it for your family? Or you want to just look back and say, I worked 15 years for free. Okay. So if you look at this and say, all right, well, $2 million. I want to put 2 million. Why not? I still am leaving myself. If I got 4.5 million in a portfolio, I'm still leaving myself 2.5 million to work for me. Okay. In 7 years, that 2.5 grows to 5 million. I'm already beyond where I was. And now I just bought myself an income of $208,000. That's phenomenal. Okay. And if I got Social Security on top of that, maybe I'm rolling around on $250,000 or $260,000 a year in guaranteed income. That's awesome. And of course, that allows me to travel, to do what I want to do, and invest in the stock market. Maybe I want to buy some SpaceX or Tesla. Maybe I want to buy some NVIDIA, or I want to just be in the S&P 500. Or I want to be some global stocks, or maybe I want to do private placements. Maybe I want to do these other things that will earn me 12, 15, 20%. And I'm okay when I have a really bad year because I know in the next few years it's going to rebound and I'll be okay. But the nice thing is I'm able to do that, and I'm able to build a lot of wealth for myself. But maybe you don't want to do that. Maybe you just say, well, I don't want to do that, John. That's too much. I'll just throw in the S&P 500, throw it in the index fund and just leave it alone. Well, then fine. Be boring. That's okay. You'll double your money and you'll still become super wealthy by just doing that. Okay. You can do that and you can still have your income over here. You still got your $250,000 coming in here covering you. Okay. It's giving you the income, giving you the lifestyle. That's the whole reason why you build your retirement in the first place. Okay. So, but this allows you to get the best of both worlds. You get the income, you get the growth. The end. Okay, that's really the best way to do this. So that's my personal opinion, but I can tell you right now That's the opinions of many, many wealthy retirees who are reaching out to me right now. That's exactly what they're doing. They are using their annuity contracts to provide income. So it's like they never stopped working, right? So then that allows them to be the smart investor they want to be, not the emotional investor, and invest and hold and save and grow their wealth. And it allows them to get far wealthier than they wouldn't have otherwise because they were just so scared of losing everything. You get to a point where you get so much accumulated, you're so scared of losing it that you put all of it into some really bad investments, okay? You have investments that are limiting your downside and limiting your upside and really just limiting your wealth in general, right? Why do that? Just take a portion, get lots and lots of guaranteed income. Don't worry about that portion. It's done. You've spent it and you spent it wisely, okay? Now you're giving yourself a huge pension. The rest of it, now you don't have to take your whole portfolio and slice and dice it and put in all these different types of variations. You can just put it all in stock if you want, or whatever you want. You can be as risky as you want, and you can build that wealth up a lot faster and be more aggressive and be okay when the market's down because you don't have to go in there and sell. Like, yeah, you might not like it when the market's down, but at least you know you don't have to because you got that check coming in every single month. So anyways, that's what a lot of people are doing, and they're doing it very, very well. And they do it for themselves, for their spouses, and interest rates are great right now, and that's why people do it. So anyways, that's all I have to say about that. I hope this video is helpful. If you like it, subscribe, share, comment below. And of course, if you have questions or if you want to purchase an annuity, reach out to me. Okay, there is a link below this video that goes directly to my calendar. There's a link on my website, johnstevenson.com. You can go there. You can book a call. It's a Zoom meeting. And we will get on there and I'll share my screen. I'll show you what's available. And then you can decide if it's something that you want to pursue. So, of course, I'd love to help you purchase an annuity, but that is totally your call. So I hope this is helpful. Hopefully you're not feeling pressure. Hopefully you're just feeling educated and you're feeling like you're getting some questions answered. And if that's happening, then that is the goal of this video. And I do appreciate you for watching. I do hope that's valuable. I hope you're taking advantage of all my other content online. I've got my podcast, I've got my YouTube channel, I've got my blog, and I really do try to share as much as I can because there are so many people retiring right now that need this information and they're trying to make the right decision. And unfortunately, there are advisors out there that know this and they are pitching them the products that pay them the highest commissions and pay the customer the least. So, and that's not good and that has to stop. And that's why transparency is key. So anyways, do your research and then reach out if you feel so inclined. So thanks a lot and we'll see you next time.